We are looking live at Nuburu Inc., ticker symbol BURU, which is currently trading on the NYSE American at $0.3372. That is a drop of about 3.27% in today's session. The stock is caught in a tight intraday range between 33 and 35 cents, but the volume is already significant, with over 34 million shares changing hands. The immediate gut check here is that this is a stock in motion, a sub-50-cent name trading with the kind of volume you'd expect from a large-cap company. But the story here is not what you see on the one-day chart. The expectation many traders have, especially looking at forum discussions and technical analysis posts, is that BURU has found a bottom. They see the 52-week low of 12 cents hit back in September and the subsequent absolutely massive 164% rally over the past month, and they see a classic breakout. They see the enormous average volume, often exceeding 250 million shares, and assume a major accumulation phase is underway for a high-tech pioneer. The reality, however, is that Nuburu is a company in the midst of a profound identity crisis, facing severe financial distress, and it has attracted one of the largest short positions relative to its float on the entire market. Let's first address the common ground, the narrative that brought this stock to the public's attention. Nuburu went public via a SPAC merger, promising to be a leader in blue laser technology. This technology is genuinely interesting. The core idea is that high-power blue lasers are far more effective at processing certain reflective metals like copper and aluminum than traditional infrared lasers. This has direct applications in critical growth industries: welding battery components for electric vehicles, manufacturing advanced consumer electronics, and even 3D metal printing. This was the story sold to investors, a pure play on next-generation manufacturing. But that story has completely broken down when confronted with the company's operational performance. The company has failed to generate meaningful sales. Financial reports paint a stark picture. For the second quarter of 2025, the company reported a net loss of over $12 million. Total equity is not just low, it's deeply negative, standing at negative $44 million. This is a company with significantly more liabilities than assets. Shareholders have faced substantial, repeated dilution as the company issues shares to stay afloat. This financial reality is the core of the bear thesis. It's the reason why this stock is not just being ignored by institutions, it's being actively bet against. When we look at the short-selling data, it is staggering. According to the most recent exchange-reported data from mid-October, Nuburu has over 20.4 million shares sold short. This represents an almost 60% increase from the prior reporting period. More importantly, this amounts to roughly 27% of the entire public float. To be clear, this means that for every 4 shares available to trade, more than one of them is a short position. This is an exceptionally high level of bearish sentiment. It signals that a significant portion of the market believes the company's financial situation is untenable and that its share price is destined to fall further. Now, often, when retail traders see a high short interest figure, their immediate thought is a short squeeze. This is where the analysis needs to get more nuanced. You have to look at the short interest ratio, also called days to cover. For BURU, this ratio is incredibly low, at around 0.1 to 0.2. This is because the average trading volume is so astronomically high. What this number means is that if every short seller decided to buy back their shares, it would take them only a fraction of a single trading day to do so. Given the current liquidity, this makes a disorganized VW-style squeeze very difficult to orchestrate. The shorts are not trapped. They can get in and out with ease. We can also look at the cost to borrow. This is the interest rate shorts must pay to borrow shares.
Data from Fintel shows this rate hovering around 8% recently. While that is certainly elevated and indicates a high demand for shares to short, it is not the 50%, 100%, or 200% rate you might see in a stock that is truly impossible to borrow. Furthermore, we can look at the off-exchange short volume. Data from FINRA consistently shows that on many recent trading days, over 50% of the total volume has been marked as short sales. This is not just old shorts covering. This is persistent, daily, aggressive short-selling pressure. The short thesis is simple. The company is burning through cash, its equity is negative, and its core business has failed to launch. What's your take on that 26% short float? Is it a sign of smart money seeing the financial reality, or is it just betting against a turnaround that's already in motion? This brings us to the reality part of the equation, the company's dramatic pivot. The expectation is still rooted in the blue laser for EVs story. The reality is that Nuburu is attempting a full-scale transformation into a defense and security technology company. This is not a minor shift. It is a complete change in direction. The company has formed Nuburu Defense LLC. It has raised new capital, including a $12 million public offering in September, specifically to fund this new plan. It is using this capital to acquire other companies. It has targeted Tecne, an Italian defense tech firm, and Orbit SRL, a SaaS startup. Just last week, on October 22nd, it announced a strategic alliance with Maddox Defense to create a controlling interest joint venture to advance drone technologies. So the company that was supposed to be welding copper for batteries is now pivoting to drones, electronic warfare, and operational resilience solutions for government and military clients. This pivot explains the massive volume. It's a war between the legacy shorts, who are betting on the company's bleak financial history, and a new wave of speculative traders who are betting on this transformation plan. This plan is not without its own significant hurdles. The company's recent past is littered with red flags. On October 13th, Nuburu announced it had received a warning letter from the NYSE American Exchange. This wasn't for its low stock price, but for violating exchange rules by failing to provide advance notification before issuing a press release about its new dual CEO structure. Material news released during trading hours. This kind of misstep does not inspire confidence in corporate governance. When we check institutional ownership, the picture is just as bleak as the financials. Only about 19 institutions hold any position, and in total, they own just over 1% of the company. The largest holders are Vanguard and Fidelity index funds, which are forced to own it as part of their total market baskets. There are no major active hedge funds or specialist tech funds building a position. In fact, recent filings show that major trading firms like Morgan Stanley, Virtu Financial, and Jane Street have all liquidated their positions, effectively washing their hands of the stock. So where does this leave an investor? The expectation of a simple technical breakout in a high-tech laser company is wrong. The reality is that this is a financially distressed microcap attempting a highly speculative pivot into the defense industry, a sector that is notoriously difficult to break into and requires deep relationships and long development cycles. The bull case is no longer about blue lasers in factories. It's about whether this new management team can successfully roll up several small defense companies and win contracts before the $12 million in new cash runs out. The bear case, which is being emphatically stated by the 27% short float, is that this is a last-ditch effort and the company's negative equity and history of cash burn are insurmountable. The future of this stock will be defined by this tension. The key catalysts to watch are not related to industrial laser sales. The things that will move this stock are announcements of new acquisitions, the successful closing of the Tecne deal, or most importantly, the announcement of any actual defense contracts that bring in real, sustainable revenue. On the risk side, The primary catalyst is the next quarterly report. If the cash burn continues at its current rate without new sales, and if this defense pivot shows no early signs of traction, the bears will be vindicated. For anyone tracking this, the actionable data points are clear. First, you must watch the bi-monthly official short interest report from the NYSE. If that 20.4 million share figure starts to decrease, it could mean the short thesis is weakening. If it grows, the pressure is mounting. Second, watch the daily FINRA short volume reports to see if the aggressive daily shorting continues. Third, ignore the old blue laser press releases and focus only on news related to the defense acquisitions and any potential contracts. This is no longer an industrial tech stock, it's a defense startup roll-up. Comment below with your thoughts on this defense pivot. Is it a